What's better than earning money from a 9-to-5 job? It's earning money while you sleep, which is made possible if you start investing. You're listening to the Real Estate Investing Demystified with your very own dynamic duo, Ava Benisaki and August Biniaz. Tune in as we discuss everything real estate, both on the passive and active sides. We feature life-changing stories of today's real estate leaders that will help build your own roadmap to success. This is a show that will lead you to a diversified portfolio, a much bigger revenue, and a next-level venture that brings you a smooth cash flow. Let's get this episode started.
Hi, everyone. Thanks for being with us. We're shooting a special segment of our show, which is going to be somewhat of a market update here with our Director of Acquisitions and my good friend, Paul Hopkins. How are you doing today, Paul?
Doing great. Thank you. Yeah. How about yourself?
Great, man. Thanks for taking the time. I know you're in Victoria, a bit cold over there. I'm here in sunny Florida, just making sure I don't get a sunburn. But you got skiing. You beat me there. But
that's right. Yeah, you definitely have the warmer weather where I've got a cooler weather, but yeah, in opposite ends of the continent.
That's right. That's right. Exactly. No, I wanted to make this video, and this kind of really been with our conversation over the last month or so, and also kind of the work we've been putting in, myself as the Chief Investment Officer, yourself as the Director of Acquisitions, in relations to kind of deal flow, underwriting, analysis, what we're seeing really in the market. Maybe give us kind of a overview of what you've seen, in the past couple of quarters. What have you seen in the markets that we're focused on in the Jacksonville, Tampa markets, which is our main primary markets we're focused on. But we also look at Southwest Florida, Naples, Sarasota, Fort Myers. We look at Space Coast. Give us overall what you're seeing in the market, if you don't mind.
Yeah, well, it's no surprise that 2023 was a pretty unique year. Overall deal volume compared to previous years is about an 80% drop. It's pretty evident as to what we've been seeing in Jacksonville and Tampa. Not a whole lot of deals that are coming out for 2023, mainly because the rise of interest rates, which also increased cap rates, at least for the buyer's side. And then there was a big disconnect between the sellers. So there's a lot of interest or sellers that wanted to sell or maybe needed to sell. But there was such a big disconnect between what buyers were willing to pay and what sellers were hoping for. So, out of basically all the deals that we looked at, we had about 170 plus deals that we looked at in the Florida market. And out of those 170 plus deals, we took a serious look at 22 of them, put in offers on half of that, so about 11. We made it to best and final, but we just couldn't come to an agreement on price and terms with some of these sellers. And out of those 11, I would say maybe 10% actually traded.
That's mind-blowing. That is mind-blowing. And we have a software that we kind of follow the lifespan of a deal as it comes into our inbox to the day that either we pass or we lose on a deal. But we also, what you do is, extremely important is you actually follow up with the broker to see, hey, did the deal trade? Who ended up buying it? Like the research that you put into it. But yeah, continue there if you don't mind.
Yeah. So that just was an indication too that, there's still that disconnect. The people that sold in 2023 were those that needed to sell. They had debt that was coming due. They were at the end of their term, or they've held on to this property or their property for a long period of time, and they just needed to capitalize on it and put their money elsewhere. So very slow deal volume for last year. We were hoping for an uptick. It seems like there's quite a bit of optimism out there from the brokers that we've been talking to that 2024 is going to be better. Once you hit rock bottom, there's only one way to go, which is up. So we're all pretty optimistic about 2024.
And just for me to quickly note here, when
Yeah.
we talk about hitting the bottom, we're not necessarily talking about only kind of the prices and the market hitting the bottom, because a lot of scholars believe the recession is coming in later on in the 2026, 2027, like a full-on market recession and what have you. There's a lot of different theses on what's going to be happening with the market. But when you see an 80% year-over-year drop in our markets, and it was 70% year-over-year drop in multifamily transactions nationwide, but particularly in Jacksonville and Tampa, that's even higher at 80%. So maybe you can give us some stats on Jacksonville. We had some great stats on that, and very interesting for people to know those numbers.
Yeah. So Jacksonville, there was only 11 properties that were over 100 plus units that closed last year. Which
2023.
yeah, good for 2023. So that's a big drop. And when you have that, it's really hard to know exactly where the market stands as far as like cap rate is concerned, because you got with only 11 properties, it could be a handful or a mixed bag of like A class, B class, C class properties, which all, they'll trade for different reasons, but it's really hard to get a good gauge on what the actual cap rate is in that market. So as new deals come in, we're just kind of having to make basically our best guess in forecasting, where we feel that the market is going as far as cap rates, what deals are going to be trading, with the potential Fed cuts this year, the potential 3 that we're all hoping for. This will definitely help bring those cap rates back down or more into an alignment with we'll just call it the norm. So maybe there is no more norm, but at
Sure.
least a little bit more stable.
Last item on this is also another interesting. The KPIs that we keep here at CPI is that from the deals that we made it to the best and final, over 50% of the deals never even traded. That the sellers actually took them off market for whatever reasons that they had, and these were sellers who had the privilege of not needing to sell and just taking a deal off market. So that was very interesting as well.
That's right. Yeah. Some of those deals resurfaced back up actually with a different broker, maybe. The seller was probably not too happy with the results that they got with one broker, so they went to a different broker firm. We see these deals pop back up like 4, 5, 6 months later. And again, the sellers aren't getting the pricing that they're expecting, and so they just decide to hold on to it. So lots of those deals kind of surfacing and it just never gets traded. So we're seeing a lot of that too.
Okay, awesome. Yeah, let's get to the kind of the purpose really of our video is talking about a lot of brokers have been telling us the light at the end of the tunnel, the kind of the sunny day after the kind of the cloudy and stormy weather, which is it's all culminates with this NMHC, which is a conference that a lot of investors, a lot of stakeholders, brokers attend every year. So tell us about NMHC and why has this been such an important event and a catalyst for more deals coming into the market?
Yeah. So NMHC is an annual event that's held at the beginning of the year. It's a chance for everybody to come into one location from different geographic areas. So this year it was held in San Diego, and it was over a couple of days. Many of the brokers that we work with attended this conference, along with lots of institutional buyers, other buyers, syndicators, really just to provide an overview, an economic overview of 2024, what happened in 2023, sharing some statistics and their overall opinion of what's going on. But it's also traditionally a milestone where activity starts to happen immediately after that. So more deals start to surface. There's usually an announcement of several deals from brokerage firms at NMHC. But there was an anticipation for us that there was going to be a lot of deal flow and volume coming out. But after getting some feedback with some of the attendees and the brokers that attended there, they're still very cautious and optimistic about how 2024 is looking. But it sounds like that there's going to be a volume of deals that are coming, not as fast as we thought, but more definitely towards the later half of the year. Broker opinion of values, BOVs, have gone up. There's lots of sellers that are interested in selling, and
BOV is when a broker kind of evaluates a property for a potential seller out there that gives their price that they believe they can sell the property for. So they're getting more of those.
They're getting a lot of those, and that's just showing that there's definitely interest for sellers to put their properties on the market. But if the seller receives a BOV back on a valuation that doesn't quite align with what they were hoping for or what they underwrote for, they'll probably just hold on to it, and it doesn't actually get out to market. So we know that there's a lot of BOV volume that's up, and we're just kind of waiting for that right moment to happen when maybe the interest rates come down, there's more of an alignment, and more deal flow coming basically to everybody out there. So
Got it. And
overall, it was pretty positive.
okay.
And
maybe we can break them down a bit. So like, what was the consensus when it comes to interest rates? Was it talking to all the brokers, everybody who attended? Do you see that? What's the consensus you're getting? Is the interest rate they believe, Chairman Powell that he'll reduce rates? What is that looking like?
Correct. Yeah, it sounded like a statistic that I heard was about the 80% of the economists that were at NMHC had predicted 3 Fed cuts this year. When that might happen, not exactly sure. But that's what the 80% of them are predicting. So that's a positive sign that there's going to be 3 Fed cuts this year.
Got it. And then how about, so deal flow we talked about, because they're doing a lot of BOV, so the potential deal flow obviously it's higher. Let's discuss distress. Was there predictions of a lot of deals, a lot of syndicators who are in trouble, all the news that we're hearing these days for a lot of groups that are in trouble? What was the consensus on distress?
So there are, I couldn't tell you the exact number in each of these markets, but a lot of deals were purchased. There was a heavy amount, like a record-breaking number of deals that were purchased in 2021 or 2020 on these short-term bridge loans that were about 2 to 3 years. That year for maturity is now. So there is a bit of distress. There's sellers or owners that their notes are coming due. They're at the end of their term. The interest rates are much higher. They either need to make a decision, hey, do we need to buy a next rate cap, interest rate cap? Do we sell? Do we refinance? There is a lot of distress, but banks also realize that they're in a position too. They can't just foreclose on all these properties because then that leaves them managing all these deals and putting them in a position that they're not comfortable with. So
they're afraid of bank runs. They're afraid of what happens to other Silicon Valley Bank and other banks. They're being very lenient, even not banks, but also other institutions to do lending. We're seeing, for example, Arbor is being very lenient on their borrowers. That something was shocking to us, because Arbor is known to be a very rigid type of lender, that if you're late a payment, that it could result in litigation or what have you. But they've been very lenient with their borrowers.
Exactly. And so they're working out deals. They're making they're making agreements to improve their operations or improve their NOI, give them another year or 2 extensions, and basically kicking the can down the road, hoping that with the interest rates that are coming down later in this year, that's going to really help. There's also the rate caps. To purchase a rate cap went wild last year, and banks realized that that's not normal, not necessarily fair to a lot of the operators. And so there's been a lot of pressure to bring these rate caps back down to reasonable levels, where a good operator would have set aside enough of a reserve to buy these rate caps. But then when the rate cap is like tripled in price in a couple months time frame, it, nobody's going to be able to be prepared for that. So there's been a lot of pressure from financial institutions to bring those rate caps back down, which is going to help out a lot with the distress. So, we were also hoping for, some distressed deals to come in so that, we can kind of come in and save the day. But it may not pan out that way just from how everything is kind of shifting and what we're hearing and all the banks working with these operators. So.
Got it. Got it. Let's talk about another very important topic. Let's talk about rent growth, because that's a metric that's super important. And every time you're underwriting a deal, and you and your team, and then we get together and look at our assumptions on the rent growth, a small kind of increase or decrease in our assumed rent growth affects the LP returns significantly. And
Absolutely.
historically it was, syndicators or fund managers put in 3% rent growth over the holding years that they have for every single year. But in certain markets that have had such a boom, like Jacksonville and Tampa, I think they were both over 20% rent growth in 2022. And we're seeing with hyper supply, a lot of deals coming to the market. Orlando as well. I mean, Orlando is not a market we look at, but we're cautious. We're not investing, is not one of our acquisition criteria, locations that we invest in. But what was the consensus around rent growth? What are you seeing in your conversations with brokers, with lenders, with others, NMHC or otherwise?
Yeah. So something's got to give. With the record growth in rents over the last couple of years, we're now basically playing catch up, or the market is playing catch up with itself. So, it has to kind of level out, we feel. But on top of that, there's a record number of deliveries that happened all across the U.S., but also specifically in Jacksonville and Tampa.
That was because debt was so cheap. Borrowing money was so cheap. A lot of developers, a lot of landowners that were sitting on these lands, it actually made economic sense to build. They started building it. So there's this huge wave of, their absorption is there as well in many markets, but there's still a wave of construction and newly built projects, some potential in distress that we're seeing as well. But keep going, please.
Yeah. So luckily there is, at least in Florida, there's net migration that's happening. There is population growth. So these new units are being absorbed, meaning that they are being occupied. The occupancy is coming back up in these units that are brand new developments. But what it does is it takes away potential tenants from other properties, mostly the Class A, Class B areas or properties that the absorption is coming from, and it makes the occupancy basically drop in similar comparable properties. But because of all that activity that's happening, it creates a slow, basically a slowing stagnant of rent growth. In a couple of the markets that we pay attention to, some of this rent growth is actually reversed. It's gone negative over a couple quarters, just because there's so much new supply that's coming on. There's a lot of competition. And so, in order to keep occupancy high, which is important, operators are cutting their costs, or cutting the rents, offering more concessions, just to keep the tenants staying put, and keeping that occupancy high. The moment the occupancy drops, you become in a pretty critical situation. You could break some covenants with your lending. You're not meeting the debt service requirements or the coverage. And so there's a lot of bad things that can happen once your occupancy drops. So a lot of operators are doing what they can to keep the tenants there, and so they lower their rents or offer more concessions. So that has spread across these different markets, softening the rent growth. So the amount of properties that are being delivered in 2024 and 2025, still a pretty high number of deliveries, but it basically drops off at the end of 2025. So at that point, we can project that rent growth is going to continue up to basically its normal levels. But over this year, it's going to be pretty flat. We, in our underwriting, when we're looking at deals, we might go 0 to 1%. And then after that, we just, could set it back to the norms of the 3% rent growth. So that's kind of what we're seeing and how we're evaluating deals these days.
Yeah, Paul Hopkins, you put the conservative in conservative underwriting. So a lot of time our team gets together and we look at other groups and some deals that have traded for $1 million more than what we were planning to pay for it. And then when we plug in those numbers into the model, we're like, hey, we're getting single digits return to our LPs when the LP can go put their money in money markets and get 5% or buy treasuries for close to that 4%. Why would they come in and put their money in for 8% in a syndication? But so a lot of these groups are literally very aggressive, and what changes those LP numbers is basically the exit cap and the rent growth that they're assuming. So these are important questions that LPs and JV partners need to be asking from the sponsor that they're partnering with.
Absolutely. Yeah. When you look at, as far as the deals that are closing or that where the offers have been accepted from other groups, they may have increased their rent growth and lower their cap rates to what they feel is in a normal market. But we're not yet out of that lull within these markets. So we just need to be cautious and prepared. 2023 was a good indication of what could happen in any market. We have to keep that in our minds as we move forward.
Amazing. All right. Give us, was there anything else from the NMHC that you took away from your conversations again with everyone who attended? Was any other items that
there is a lot of capital out there that is just waiting. There's lots of institutions that are hungry for deals. Lots of syndicators like us that are looking for deals. And that may be why also some of these other syndicators are being super aggressive and not very careful on their underwriting because they have a lot of capital that they don't want to lose. There's lots of money that's sitting on the sidelines just ready to jump in for the right opportunity, and that they need to invest this money wisely too. But that was kind of another key thing that I heard was lots of money out there that's waiting for the right time.
For sure. They got to keep those talent that they have employed, because it takes so long for these large institutions to bring on a talent, an employee, an executive to head a division. But then if you don't have deal flow, what do? You get rid of that person. That's going to be very difficult. So they're going to
exactly.
We have some friends as well in the space, obviously, and they're keeping their teams busy with other aspects internally, building the company internally, not trying not to lose that talent, but also staying afloat. So very interesting time. We talk about this next item on a daily basis, myself and you, on our few of our weekly calls that we have, or whenever we jump on a call and chat with each other. Let's talk about some predictions you're seeing here. Personal predictions you have. What do you think about interest rates? Do you think that the Fed will actually decrease interest rates? Do you think that inflation will be able to be controlled eventually, ultimately here? What is your view on interest rates?
Well, I kind of have to follow some of the expert economists that are out there as well. Just you can't ignore what they've been saying, but in reading between the lines, I do think that there is going to be potentially up to 3 cuts this year. At least 2 is my prediction. So hoping for the 3rd, that'd be the best case scenario. And what I'm also predicting is insurance costs. I feel that the insurance costs they got wild, especially in Florida, where they could have tripled in certain locations. But I feel that the insurance costs are going to actually stabilize or come back down. There's more of an appetite for a couple of the insurance companies that got out of these markets. They're going to come back in, creating more competition with insurance and underwriting.
And you're hearing that from both brokers and insurance salespeople and everything?
Correct. Yep. So the conversations I've been having with our insurance broker, and also different lenders and brokers, they're all hearing that same thing, that unfortunately insurance companies, they look in a rear view mirror as to like what happened in the previous years. There's been an increase in natural disasters and claims across the U.S. and they have to make up their money somehow. So they're in the business of making money, and unfortunately, it falls back onto the operators and then eventually the tenants. But there's an obvious sign that something needs to happen, and I think everybody, from the government to these insurance carriers to just everybody that's kind of involved in this space, and including tenants, need to have this controlled. It's not just in commercial real estate; it's also in single family that it's also impacting. But there seems to be a consensus that insurance rates are going to stay where they are, probably come down a little bit. So I have a prediction that it will get better, and not be too much of a wild card. And of course, we'll have to keep our fingers crossed that the natural disasters kind of level out. But we shall see. That's the other prediction.
All right. Really appreciate you coming on. We should do this more often, but I felt that you were having some really engaging and great conversation together on our calls. And I said, hey, we should jump on here and record this and send it to our audience and our investors and others. So I really appreciate your time, and thanks for being here.
Yeah, thank you.
Thank you for joining us for this episode. We hope this conversation enlightened you on how to win big in this highly profitable and risk-averse space. Get on your feet and embrace this world that offers so many opportunities just waiting for you out there. Continue your journey to becoming a savvy real estate expert by subscribing to the show at cpicapital.ca. Don't forget to leave a positive rating and share with your friends. See you on the next one.